thank you for joining me this evening, afternoon, or wherever it is that you are. This is the second part of a three-part series where I talk about multifamily syndications. I have done so many different things when it comes to investing in real estate that after having been a flipper, a wholesaler, a hard money lender, I've taken the decision that multifamily investing via syndications is the best way of all ways to go, right? So we have a couple of slides here depending upon critical mass and how many people we actually get to come here, right? We're going to have breakout rooms, or we'll just have a small discussion with so many people who are in the main room. I always have to start out by showing this little disclaimer that I have, right? And what it is I'm an investor just expressing my personal opinion. I am not a financial advisor. I'm not an attorney. I'm not an accountant, right? If you are going to make any kind of investment of your own, my ask of you is to consult your financial professional before making any decisions to move into an investment. And one of the things that I want to make very clear to you is that we have a code of ethics here at Value Investment Partners, right? We do not accept any money from any sponsors or any platforms for anything, including postings, reviews, referring investors, affiliates, or advertising. What I want to show you tonight is how I underwrite a multifamily syndication, right? And I invest my own money. And if you choose to, you believe it's a good investment, you could also invest alongside of me. So we have a code of ethics that is here as well. I just wanted to let you know that everything that we're doing is above board, right? There's no snake oil salesman here. There's no underground things going on, etc. So what we're going to do tonight is we're going to cover how do you select an MSA. If you don't know what an MSA is, I'll tell you about what it is in a couple of slides, right? Once you have defined what your MSA is going to be, in each MSA, there are going to be several sub-markets. Only after you have found your MSA and sub-market, then you start sourcing for deals. Once you have a relationship with a commercial broker, or you have a relationship with a property manager, then you can start analyzing those deals and you try to put them under contract. Put them under contract, you go into your due diligence. Once you're into your due diligence, you purchase the asset and raise the capital. And then you have to do asset management and you manage the business plan from there. 5 years, 3 to 5 years after that, you get to sell it. Hopefully you can sell it for $10, $15 million more than what you purchased it for, right? But that's what we have been experiencing in this day and age right now. There are so many different investments. I am in my 23rd syndication today. I repeat that. I have invested in 23 syndications, 2 of which I am on the GP side. If you don't understand what the GP is, join me tomorrow on another meetup. Robert, could you do me a favor and put that in the chat? I'm sure you're going to be there tomorrow. But could you draw that into the chat so that we get Aaron to show up with a couple of people as well?
Oh, okay. This is Aaron's. Tomorrow night, 7 o'clock.
Yes, sir.
All right.
So selecting your MSA, downgrading that to submarkets, finding the deal, analyzing the deal is the step. So how to select MSA? Remember, I said that an MSA stands for Metropolitan Statistical Area. The way that you can think about that is New York, Washington, D.C., Atlanta, Boston. Those are called MSAs, and they're defined by, I think it's the Department of Census, etc. But those are your larger cities, right? And inside of the MSA, there are submarkets that are there. When you're first starting out in this business, you want to select an MSA where you can probably drive there or fly there, but it shouldn't be labor intensive in order to get there. Why do I say that? I say that because you are going to be raising capital from your investors, right? So your investors are saying to you, take this $50,000 or $100,000 and make sure you return it back to me plus some. If it's taking you 5 hours to get to wherever that asset is, you're not going to go there as often, and it's probably going to be a problem because the property manager, once they start to fill you out, can realize whether or not if you're going to be there or not, and they sometimes slip a little bit. Property managers, by their very nature, they're reactive and not proactive, especially when they have a team that is absent from looking at the asset. The property that we picked up in Texas City, Texas, had 132 units, and probably almost, when we picked it up, it was about 65% occupied. So that's 35%. That's like basically going to a grocery store and 35% of the aisles are empty. Nothing is there. You don't want to have that happen when you are owning a multifamily asset. Each unit is your product and it should be bringing in some kind of income, right? So I say, select where you live before you start looking external to where you live. You can find a partner if your area, like I live in the Washington, D.C. area, and it's about $250,000 to $300,000 per unit. The property that we picked up in December is about $70,000 a unit, and that was for 460 units. So it was about a $40 million purchase, right? We expect that we'll be able to sell that property in 5 years for $60 million. Just wanted to let you guys understand the numbers that we're working with. You can find your target market by doing online research, right, of top apartment markets. If you were to put that inside of a Google right now, what are the top multifamily markets, apartment markets? There's searches that will come back and tell you what that is. But the best way that you can do this is, this information is free on a website for Marcus and Millichap. Every year, every quarter, they release information about the MSAs that are performing the best. What you're looking for in an MSA that's performing is you want to buy in an area where people are moving to versus moving from, right? Everyone, lots of people are moving from New York, New Jersey, Chicago, Washington, Seattle, Washington, and they're moving south, right? Just because the cost of living is cheaper in the South. All of our investments right now are in North Carolina, South Carolina, Florida, and Texas. Texas has been a gold mine for us. Of that 23 syndications, probably 8 or 9 of them are in Texas. The last 2 that we purchased, the last 4 that we're invested in are also in Texas at the same time. You're going to want to work with a commercial broker in order to get access to things like a CoStar report. When we get into the question and answer, if you want to see what a CoStar report looks like, I'm more than happy to show you what it is. CoStar is a data collector, and they basically bring all of this data together, and it's somewhat expensive in order to be able to purchase it. So right now, and I believe it's going to be probably like $12,000 a year if you wanted to purchase and get access to CoStar on a national level. They sell it at a sub-market level, right? Well, at an MSA level, but if you have to buy 2, you might as well buy a national one, because that one is going to be just tight. If you want to go with two, you can buy the entire one for the national. Then once you have selected that submarket, well, that MSA, sorry, I'm mixing up the terms, my apologies there. Once you have down selected to your MSA, and you want to start out with looking at maybe 7, 10 markets, you're going to narrow that down to 1 or 2. But inside of each MSA, there are submarkets, right? So for instance, Washington, D.C. is an MSA. But inside of Washington, D.C., there's Fredericksburg, there's Loudoun County, there's Fairfax County, there's Arlington County. Each one of those counties is performing at a different level, right? So if you're going to be investing, you want to find the area that probably hasn't been tapped so much so that you can figure out how can you, right, get the effective rents up to the market rents. And that's how you're going to make money. How do you evaluate those submarkets? Unemployment, population. Unemployment should be going down. Population should be going up. You don't really want to, you want an age group that is somewhat transitory, where people are of the age and they are making the decision not to purchase a home. But you also want to be in an area where it's somewhat difficult to purchase a home as well. Next, and one of the most critical things that you have is employers. If you're going to have renters, you need to make sure that they're gainfully employed. So you want to ensure that the MSA in the submarket is diversified when it comes to employers. You want some manufacturing, you want some healthcare, you want some universities, you want these types of things to make sure that those employers are bringing people into the area. Next is supply and demand. You definitely want to be investing in an area where there isn't new assets coming on the market, right? Because if I have something shiny and brand new over here versus something that's a little bit old and dated here, I'm most likely going to take a look at the shiny new one. And if it's within my price range, it's going to knock out the older one, right? So if there's not new assets coming onto the market, people are going to want to come to you because it's economical. Plus, you're also putting money into the asset and they're going to see that. And finally, the last thing, one of the last things that we use when we're selecting a submarket and a state, right, is we're looking for states that are landlord friendly versus tenant friendly. If there's something going on in your state or city, like rent control or other things of that sort, as a business owner, I'm not going to be able to make as much off of that unit as I possibly can, right? So because I'm not able to make as much off that unit as I possibly can, I'm not going to be able to increase my NOI, which is my net operating income, which means that that's going to impact the value of the property because it's all trading off of the net operating income. And this is the primary reason why I'm not investing in single family rentals, is because with single family rentals, I only can increase the value of the asset based on what other houses are selling for in that area. However, with multifamily, I'm able to increase the value of the asset based on the net operating income, right? And if I can bring up the rents and reduce the expenses, that means the net operating income is in my favor and I'm doing very, very well. So hopefully that makes sense to you. If you want, we can have this to be an interactive conversation. I know I'm throwing out a lot of acronyms, so please do raise your hand right now I'm in presentation mode, so I wouldn't see it. So you're gonna have to just come off of mute until I get out of presentation mode, and then I'll be able to see it. All right, but we're gonna move on. So we know what the MSA is, Metropolitan Statistical Area, and we know what the submarket is. Remember, I said to you, there's a lot of this information that is publicly available. The first one that I would get, it probably comes out in late January, early February. It's the Marcus and Millichap Annual U.S. Multifamily Investment Forecast. If you were to go to Marcus and Millichap right now, I believe that you can download this report without having to give them your email address. But this lists all of the MSAs throughout the country and how they are performing, right? You probably don't want to go to an area where it's already booming because it's going to be very expensive. But depending upon the types of returns that you're looking to bring for your investors, that's going to determine the MSA where you're going to use. There's another entity that's very big in commercial called CBRE. They deliver a biannual cap rate survey, and cap rates are basically how properties are trading. Net income multiplied by the cap rate will get you the purchase price. You're going to want to determine what the cap rate is and whether or not, based upon the asset class that you're investing in, if it's going to generate the type of return that you're looking for. Integra Realty Services has an annual viewpoint on commercial real estate and trends. All of those trends today are saying multifamily is an asset class to be investing in, and there's a reason why. The other day I was watching 60 Minutes, and on 60 Minutes, the reporter said, and I think she was with Zillow, she was the chief economist with Zillow or Redfin. Basically, what she said is that in the United States of America today, there is a shortage of 4.5 million units, housing, 4.5 million. And because of this, there's been such demand for multifamily units that you have seen prices go up 12, 15, 20, some places even 30% year over year for access to a multifamily. As I mentioned to you, you could also use Zillow, which has an annual consumer house trend report, because if housing for first-time buyers is out of reach, their only alternative is to rent from somebody. And they can rent single-family homes, they can rent trailers and mobile home parks, right? Because they're not really building any more mobile home parks. There's so many different things, and all of these asset classes at this point in time are actually growing, right? Because that 4.5 million, with where we are in the financial cycle and the real estate cycle, I would say probably over the next 5 years, that 4.5 million is probably going to go up to maybe 5 million, right? People needing houses to be developed. The final one that I'm going to talk about, and there are plenty of free stuff out there. CoStar is what we're using, and the CoStar multifamily report is basically going to be about a 60 or 70 page report that's telling you everything about that MSA and those submarkets that are there. How much the rents are going, what's the price per square footage for an asset, how have rents been trending, what's going to be the forecast over the next 5 years. All of these things are inputs that you want to have in order to be able to judge whether or not if you want to invest in that particular MSA. And this is what we actually do for every single deal where we're going to put capital to work in. We underwrite and we fly down, we visit every single property before we put money into a deal, so that, I say if it's good enough for me, I believe it's going to be good enough for you, because our underwriting is very conservative. We ask the operator, how are they going to be able to hit the numbers that we have? And if they answer the question soundly, we will invest with them. All right, moving on. So I took a screenshot from the Washington, D.C. MSA, right? And over here, you see what's going on, Northern Virginia, right? So over here is what's going on. I think that this is Maryland, right? Because the Washington, D.C. MSA includes portions of Maryland. Over here is Baltimore. That's not going to be included in this MSA. As you're coming down here, you start to see what's going on in like Purcellville area of Virginia, right? All the way down here is when you start to get around Woodford and all of those different places. But as you can see from what I mentioned to you, any one of these sub-markets that are here could be doing differently. So here's La Plata. La Plata can be doing different than Fredericksburg or Middleburg in Florence or Frederick, right? So here are the two MSA submarkets. Why would I want to invest over here if this submarket is doing better, right? And this is where I say, if Washington, D.C. is going to be your MSA, you have to then do further research to understand whether or not if rents are going up in these different submarkets. And then once you figure out what the one or two submarkets are going to be, where you're going to basically work with property managers and commercial brokers to tell them what your criteria is, that's how you dig in. And all of this is Washington, D.C. Sorry, but I couldn't make the picture much bigger than that. But what I wanted to do right here was to give you an opportunity to understand, right? Once you select the MSA, the next thing is going to be, how do I select my sub-market, right? Because there's different things going on in the sub-market, such as unemployment, population, age, jobs, employers, and supply and demand. How many new units are going to be coming online, which are going to basically impact my offer, because people like to go for shiny, brand new types of things. And that's going to have an impact, whether positive or negative, on how much you're going to be able to rent that renovated unit for. I hope that makes sense. But all of this it's like a science and a discipline that you have to have if you're going to be investing in the commercial space. All right, moving forward. Here, once you have selected your submarket, right, you're going to develop a spreadsheet that you'll have for yourself that helps you to get like a one-page view of why it is that you want to be investing in this submarket. This is the spreadsheet that we have: Richmond, Virginia, Raleigh, North Carolina, Greensboro, North Carolina, right? And if you haven't developed your own spreadsheet, if you were to go into our private Facebook group, I believe my wife has already put this up there. But if it's not up there and it needs to be updated, we'll update it and put it onto the private Facebook group. And a lot of these presentations that we're presenting today, all of those are up on a private Facebook group that we have. You can go and download these all on your own and use it for your investing, right? So you have to have an Excel spreadsheet that tells you why, in a one-page view, you're going to invest in that submarket and why. This is a question. The reason why you want to have this is because your investors are going to come and ask you, well, Robert, tell me, why is it that you chose this area over this area? And if you have any doubt in your answer and response, it's not going to give your investor confidence. So I think that it is worthwhile for you to understand how it is that you got here in selecting that submarket. All right. Now, once you have identified your MSA, narrowed it down to 1 or 2 submarkets, the next thing that you're going to want to do is work with a property manager as well as a commercial broker. And these are just 2 people who you're going to have on your team for investing in that MSA, right? So, property criteria, multifamily residential apartments, right? Do you want flat roofs or pitched roofs or whatever have you? Personally, I like pitched roofs. I like garden style multifamily complexes. That's just my criteria. Your criteria might be different. Minimum occupancy of 80% with the exception of properties that require renovation, provided properties are well located and present value enhancement opportunities. Why did we say 80% occupancy? Because without 80% occupancy, you won't qualify for agency debt. And by agency debt, we're talking about, Robert, I believe it has to be 80. It might be 75 now, but it's typically around 80 in order to qualify for agency debt, right?
Yeah, that's correct.
Right. So agency debt is going to basically give you the best terms. After that, you're going to have to go into some type of bridge or mezzanine type of debt in your capital stack, right? And all of this is going to impact how you underwrite the deal. So if a deal is less than 80%, but it has significant value enhancement opportunities, it might be something that you want to write, because where we are in the market right now today, it's very hard to find a good deal. So if you find a property that has been underperforming, has deferred maintenance, etc., this is something that you want to underwrite. Now, after you have selected your property criteria, you want to share with the commercial broker and to your property manager, what are you looking for? Our criteria is 100 plus units between 5 and 15 million. You have to be in an MSA where the price per door would fit into that, right? We are looking to provide our investors a minimum 8 to 12% cash on cash return and have a minimum debt service coverage ratio of 1.65. And a debt service coverage ratio basically is saying, right, after we pay our mortgage, how much is left over, so that if things do go wrong, we'll still be able to cover the mortgage, cover the expenses, pay our investors, right? Whenever we look at a deal, if the debt service coverage ratio is below 1.65, we walk on the deal. It's too compressed for if things were to go wrong. Then you want to talk about what class of asset you want to purchase. And in another slide that's coming up, there's everything from A to D, right? But then there's A to D locations as well. The locations that we're looking for are emerging markets with indicators for strong near and long-term growth. As I mentioned to you, we're going to be holding this asset for 3 to 5 years, right? Excuse me. There's a lot that can go on in 3 to 5 years, right? But you want to be investing in submarkets where that horizon, based upon all of this data that you've gathered for yourself, right, shows you the characteristics and the traits and the metrics and measures that are going to be able to get you there. I hope that makes sense. I'm going to pause really quickly. Are there any questions? All right, no questions. Let's keep it moving. Tracking on good time. As I mentioned, there are different classes of property and there's different classes of neighborhoods, right? So Class A property, because really it's the property that's going to make all of the difference. Class A property is new construction, right? That's the best of the best of the best. With Class A construction, brand new, most everything is going to be under warranty and it's going to have a very low expense ratio. So the cap rate for a Class A asset right now is going to be in the 2s and the 3s, etc. I don't believe, and I have seen it over a number of deals that we've looked at, where people are paying for a Class C asset at a cap rate that's equivalent to what you have to pay for a Class A. I say no bueno, no good, no good. However, a Class A asset is really going to be able to qualify for some very good debt, right? Typically, insurance companies, etc., are going to want to invest in that, right? As the property ages, right, 10 to 15 years, it's going to move from a Class A to a Class B, right? 10 to 15 years old, there's going to be some deferred maintenance. As you do your property inspection before you're purchasing the asset, you will know, your engineers will give you a full reporting of what is deferred, right? And it should have been maintained, but it wasn't maintained, right? Class C, that's where I love to play. Class C is where the property is at about 30 years old. It shows its age and has deferred maintenance, right? Because the name of my game is I'm going to come in and I'm going to renovate every single unit so that I could get the rents to be pushed up, right? I stay away from Class D assets. That's not going to be workforce housing. Most likely a Class D asset is going to be in a high crime in a very bad area, right? I stick to B's and C class areas. If I could find a Class C property in a Class A location, right, I'm going to go for that all day, right? But this is the scale and the balance that you're playing with as you are selecting these multifamily investments. I hope that makes sense. We've spent a lot of time to basically put together all of this data, right? And in number 3, we're going to underwrite and show you how we underwrite a deal next month, right? We're going to show you how we underwrite the deal. But now, once you have a deal, you typically want to find an off-market deal, right? That means that you have contacted the owner directly and they're selling to you, because that avoids having to pay any broker fees, right? And remember, you're working in the $1 million going up to whatever millions of dollar range, and a broker takes a percentage of that. So if there's no broker involved, but typically when you start getting into the larger assets, there's going to be a broker involved, right? But the goal here is to find an off-market deal. That's like everything that you want to have, right? One of the things that we look for is conservative underwriting, right? More details, as I mentioned to you, are going to be on this in the next month. But when we say conservative underwriting, we say, how much are your expenses going up per year? If you're saying that they're only going up 1 or 2%, I don't believe that, right? How much are you going to be able to increase the rents year over year? If you say 2%, I don't believe that. right? Right now, it's about conservative underwriting, 3 or 4% year over year. There are some MSAs where rents are going up 6%, 8% year over year. The thing about it is that if the rents are going up that high year over year, the expenses are going to be trailing behind that as well. So the first thing that you do is when you have underwritten the deal and you believe that it works, right? This is something that you want to go after, right? The first thing that you do is you write an LOI, which stands for letter of intent. And this is a non-binding document that basically says, I believe that this property is something that I want to purchase. Do you want to go with me? Now, when they sign the LOI, that means that you're going to move into the due diligence period, right? And typically you have 30 days, sometimes 45 days to go and do your due diligence. That's when you bring in your engineers, you walk the property. And remember, when you're walking a property, you are going to walk every single unit. If there's 200 units, make sure you wear your sneakers because you're going to walk every single unit. If it's 300 or 400, you probably bring a team and you divide all of the units. I would do it in a 200 unit as well. But what you're going to do is you're going to go into every single apartment and do an inventory of what needs to change. And it's just a visual inspection. Do I need to upgrade the kitchen? Yes or no. Does it need new appliances? Yes or no. For every single unit. The next thing that you have to do while you're doing your due diligence, right? But before you go into your PSA is, and the PSA stands for purchase and sale agreement, right? Right. You want to let your investors know that you have a deal. And when you move into contract, you're going to be raising capital, right, to secure that deal, right? And there's all different kinds of ways that you can raise capital. There's Regulation D, 506B, there's 506C. There's an entire book written by a lady named Kim Lisa Taylor on how to raise money. There's another book by Hunter Thompson. Those are the books that I refer to when I need to understand something about raising capital. But this is where if you're making a $10 million purchase, you're going to have equity that you're going to put onto it, right? So a $10 million purchase, you're probably going to have to come in with about 2 to 2.5 or $3 million for that. The rest of it, you're going to put debt on top of it. So the banker is going to be your best friend at that point in time. Next, you have to secure the debt. And Robert is on a call with Garden State funding. He would be the guy who you would go to, and Robert would be able to say, well, let me work with you to see how I can get you the best financing on this deal. And last, as you're doing your analysis for your deal, you want to be working with your property manager as well as your asset manager. They're two different entities, two different roles in the deal. Your property manager is going to give you a budget to run the property and make the types of renovations and help you to determine whether or not if you're going to be able to increase the rents to make those investments work. Your asset manager is doing the same. You're going to compare all of those numbers that you get, and that will tell you whether or not if this is a deal that you can move forward with. Remember, as you underwrite the deal and you send out your LOI, once it's accepted, you're going to have to put your earnest money deposit called the EMD with the closing attorney, and they're going to hold that until you either walk away because during your due diligence stage you found something that you didn't like, right? Or you're going to go, once your inspection contingency terms are over, the term is going hard. When you go hard on your money, that means that you can't walk away. That money that you put into your EMD now is basically with the seller unless one of the contingencies that you have at that point, usually that might be a financing contingency or something like that. But once you go hard, that money is now going to go to the seller. So I hope that that makes a lot of sense. All right. It's 7:51. And I'm going to open it up for any questions that anybody may have. I know that, I spoke a lot about this, but many of you who have been with me for a while, right, will understand this is something that I've done over ad nauseum, right, to tell you how you can invest in multifamily syndication. A lot of people don't believe that this is something that they can do. Right. And remember, I grew up with a plastic spoon. We did have a plastic spoon. I didn't have a silver spoon in my mouth, but I grew up from humble means is what I'm going to say. And I've been able to grow my wealth substantially since 2017 by investing in multifamily syndications. And Robert, I believe you might have put tomorrow's meetup in the chat, but I'm going to go there tomorrow and I'm going to take what I've done here and evangelize it just a little bit more of the secret, and not a secret, but the formula that I have put together in order to be able to invest in right now 23 different syndications. So come on, give me some questions.
Very good, Lee. Nice presentation. And I invested in my first syndication, and that was a few months ago. So I'm looking to get involved with more of them because I haven't received the fruits of the labor yet, but it's all on its way. It's on its way because it's brand new. But I do some stocks and investing on my own also, but I love this game about real estate. There's so much advantages and, with the stock market, it's crazy with the up and downs. Things are so volatile right now with companies out there. So real estate, I just want to get involved with more multifamily syndication on the passive side. I don't have any active properties other than my, our personal home, but trying to do more syndications definitely on the passive side because it's a nice way to invest.
Well, we have 3 people on the call because I know the first multifamily syndication that I invested in was with some local people, and it was $100,000 investment. Robert, if you are comfortable, could you share are you comfortable sharing what that investment amount was?
Yeah. For my own personal, I put 10,000. I put 10,000 into the deal. And I'm actually not a, what do they call accredited investor.
Okay.
I come in as I guess it's a sophisticated investor, but I was allowed to put whatever dollar amount I want above $100. So I just wrote a check for 10,000, wired it.
No. Hey, Robert, $10,000 is nothing to sneeze at.
Yeah.
$10,000 is nothing to sneeze at. The reason why I wrote a $100,000 check was because I knew these people for 5 years, right? So I knew where they lived, I knew their husbands, I knew their families, etc. Can you help me to explain how is it that you got to the point where you were comfortable wiring over a check for $10,000 of your hard-earned money?
Yep. I think it all built on the trust of who I was dealing with and who was presenting this deal as a syndicator and a sponsor and the GP. And I kind of, actually, I never met them in person, the people that are running this particular syndication, but I trust the property. It's in Texas. So I kind of picked Texas way back then when I started out, when I was trying to get involved and doing what you're explaining here and, learning about the multifamily and doing all the capital raised and different things that go along with this. But I just didn't have time. I don't have time to do that as a business because I'm running my own lending business.
Yes.
So I was looking for the right folks to invest with, and I probably got to know these folks for about a year and a half since the pandemic hit, all online, because I see what is going on each day or each time we have these meetings. And that's how I did it. I invested, and I'm just waiting to get my first quarterly dividend, I guess they call it. Distribution, and then there'll be more to come, and maybe within 3 to 5 years, I get all my capital back plus all that interest to go with it. So I don't have to worry about the stock market with that.
Sharing your story and part of your journey. And the reason why I put together Value Investment Partners was because my second deal, right, was to send $75,000 to a bunch of people who I didn't know, and I had to get them to know over the internet. I didn't go with that $75,000 deal just because as I was Googling and learning different things about those operators, they didn't pass the smell test. But I was like this close to sending $75,000 to some people who I met over the internet, right? I went with another investor with my mentor. She showed me a different way to do it. And that's when we went into number 2. And on my website, that's Las Colinas, which is in Texas, Dallas, Texas. And the next one that I went into, the name has changed, but now it's called Lexington. That's on my website. And we just got notification that both Lexington and Las Colinas are under contract and to be sold. And they're looking at generating at least a 20% IRR on those properties. The one that I invested initially, that's Abbey Lake, where we invested $100,000 into that one. That property is performing really well. And since that's the first one that I invested in 2018, 2017, 2018, because it was around November, December, I'm waiting for that one to sell. And I'm expecting that one, when it sells, it's going to return my capital $100,000, and it's going to return me another $100,000 on top of that, right? And meanwhile, by holding it all of these years, if I looked at my account, they probably have sent me north of $25,000 while I held it. All right.
Very nice.
No, I got in at the right time, and I'm happy when I got in. The market right now is compressed. I don't know whether or not if it's going to continue to be able to show these returns, but when you look at it from an investor perspective and the lack of housing, I think multifamily is a great place to be because of that. Lack of housing, cost of buying a new house is so expensive, right, that people can't just afford to move into a home, so they have to rent. So I think the market dynamics are there. All right, Anthony, first time on. I know it's a lot of information, but what do you think?
It's got me to be a little bit more in the know with this. This is my first time, so it was a lot of new information, but this was, definitely took a couple tidbits, some insights from your presentation, and then of course hearing the perspective of Robert too. It sounds good. Of course, I want to learn more.
You don't have to go in at 100,000 in most of these 506Bs, which is what we put together, right? The minimum investment is typically $50,000. But like Robert did with this operator, they were allowing him to come in because with a 506B, you're allowing up to 35 sophisticated investors who can come in at a lower amount. So what you're trying to do is you're trying to give them an opportunity at that lower amount to come in and be a part of this journey, right? So Robert, congratulations on your first investment. And, I'll keep in touch with you just to see how the deal is doing. And
Yeah.
hopefully next time Anthony will come in with one as well.